What is a leverage in Forex trading? Unlock the potential of your trades with leverage in Forex trading. Amplify your gains with controlled risk for strategic market plays. Do you know the Forex market trades over $5 trillion daily? This big activity is mainly because of leverage in Forex trading. It's a strong tool that lets traders control big deals with just a bit of money. Leverage means getting extra money from your broker to make more from your investment. In Forex, it lets you use more money than you have. For instance, with a 100:1 leverage, you could trade $100 for every $1 you have. This way, small gains can be big, but so can losses. So, using leverage safely is really important. Without leverage, making money from small price changes in Forex would be hard. But leverage turns these small changes into either big wins or big losses. It's like a sharp tool that needs careful handling. The Forex market trades over $5 trillion daily, greatly utilizing leverage. Leverage allows traders to control large positions with small deposits. High leverage ratios, such as 100:1, are common in Forex trading. Proper risk management is crucial due to the amplified gains and losses. Understanding leverage in Forex trading can lead to more informed trading decisions. Forex trading is well liked by investors for its easy buying and selling. It's also known for offering big returns. Traders use leverage to make big trades even if they don't have a lot of money in their account. They borrow funds from their broker to do this. Leverage means using someone else's money to make more money. It's a way to amplify possible returns, and it's basic in Forex. The leverage ratio shows how much bigger a trader's position can get compared to their account balance. There are different ratios like 10:1, 20:1, all the way to 100:1. This means you might only need $1 in your account to trade $50 worth of currency. Knowing how leverage works is essential for traders at all levels. In Forex trading, leverage means you can control a large position with a small amount of money. Here's how leverage works. The trader picks a leverage ratio based on their strategy. They put in the required margin, which meets the broker's rules. The broker then adds money to their account. If the trade goes well, profits are big, but if it fails, losses are too. If losses get too high, the margin call happens. The broker might close the trade to avoid more loss. It's crucial to be smart about how you use leverage. You should consider if it fits your financial situation and risk tolerance. There are rules about how much leverage you can use, like a max of 30, 1 in the EU and 50, 1 in the US. These limits are to protect traders. Leverage helps Forex traders increase their returns and access larger parts of the market. It lets them trade with more money than they have in their accounts. This text explains why leverage is popular and how to use it wisely for bigger profits. Traders like leverage because it can make their profits much bigger. For example, with $1,000 in their account, they can trade as if they have $50,000 through 50. 1 leverage. Without leverage, a $5,000 trade might only give a $71 profit at a 1.4% gain. But with leverage, the same trade could make $600 at a 12% gain. Yet, remember, leverage can also increase losses. Leverage opens the door to bigger opportunities in the market. Even with just a $1,000 account, a trader can move as much as $10,000 through 1 leverage. This lets traders of all sizes take on larger market positions. It means more chances to profit from significant moves in the market. Leverage lets traders increase their market reach for the possibility of bigger gains. Learning to use leverage correctly means more opportunities in Forex. Margin in Forex trading acts like a security deposit. It's needed to start and keep leveraged trades open. This deposit ensures there's enough money to handle potential losses. Brokers can set different margin requirements. This is influenced by what currency pairs are traded and the trade size. Usually, margin is a percentage of the trade's size. If this percentage is 1%, then with a $1,000 deposit, you could control $100,000 in currency. Large accounts, over 100,000 currency units, might need 1% or 2% margin according to the rules. During the weekend, some brokers might ask for more margin. This is because there could be more risk. Often, a maintenance margin of 100% is needed. This ensures that trading accounts meet the rules all the time. Margin accounts use the initial deposit as a security. This protects both the trader and the broker against losses. It's a key part of managing trading funds and protecting investments. If you're losing money close to your original deposit, brokers might make a margin call. This means you need to put in more money or close some trades to lessen the risk. If big losses happen, the broker could sell your assets without warning, known as a margin call. It's important to know the difference between Forex and securities margins. In Forex, margin is for securing your trades, not for borrowing money. But in securities trading, margin is about borrowing from the broker to buy stock or other investments. Traders need to understand these different approaches. This table shows how leverage ratios affect margin requirements. Leverage lets traders manage bigger positions than their actual capital. For instance, a 30. One leverage needs a 3.3% margin. Leverage ratios vary widely in Forex trading and can greatly affect your trades. It's important to know how these ratios work to do well in the Forex market. Forex leverage ratios usually range from 50, 1 to 100. 1, unlike equities and futures that have lower ratios. In the past, some brokers allowed ratios as high as 400, 1. This let traders control $100,000 in currency with just a $250 deposit. In the US, a 2010 rule changed the max Forex leverage to 50, 1 from 400, 1. This meant depositing $250 allowed controlling only $12,500 of currency. This change was intended to lower big risks. Margin requirements control how much a trader needs in equity to use borrowed funds. This can change the maximum leverage a trader can use. For example, a 2% margin requirement allows leverage up to 50. 1. Brokers decide the margin-based leverage they offer based on their own risk limits and how volatile the market is. Using high leverage can boost both wins and losses. So, knowing your Forex leverage ratio is very important. Remember, quick changes in the market can mean big changes in your account with high leverage. Brokers protect themselves by making margin calls. They do this if a trader's account equity falls below what's required, which might force the trader to close some positions. To lessen risks, consider trading with lower leverage and use good risk management. This includes not putting too much money in one trade and keeping enough money in your account to cover potential losses. Leveraging in Forex trading lets traders control big positions with a small amount of cash. For example, a 2% margin lets you have a 50, 1 leverage on an EUR USD trade. This means you could trade a position worth $50 with just a $1 deposit. However, this also means that your profits and risks can both get bigger. Forex brokers, including FXTM, offer different levels of leverage, like 150, 1, 100, 1, 200, and up to 500. This leverage can turn a 10,000 euros investment into 1 million euros. But big levers, like FXTM's 2,000, are best for those who know what they're doing. Newcomers might prefer much lower leverages, maybe 1, 5 or 110. Using responsible leverage matters a lot in Forex trading due to its high risks. The amount you need to keep trading, the margin changes by currency pair. For major pairs, margins are usually 2% to 5% of the trade's value. For less common pairs, it might be as high as 20%. Knowing these margin needs is important to use leverage strategies that fit your risk comfort and market conditions. For good leverage strategies, you should keep leverage low and be careful with how much you risk. It's smart not to add more money to losing trades. Using stop loss or trailing stop orders can protect your money. These moves are crucial for lasting success in Forex. There are also companies like Charles Schwab Futures and Forex LLC that handle Forex trades with straight-through processing. This way, trades go straight to the market without delays, making them a trustworthy option. At Charles Schwab, if your equity falls too much, they might close your trades to protect you. This highlights why managing your margin and risk is so important. Being careful with leverage can prevent you from taking on too much risk and avoid big losses. Using a 1:50 ratio is seen as a safe and smart way to trade. It helps you control risks while still taking advantage of the Forex market. Whether you're just starting and using a 100 leverage or you're experienced with bigger ratios, the secret to doing well in Forex is smart and careful leverage use. This is true for all traders, no matter their level of experience. Using the right risk management is key when you leverage trades in Forex. Understanding and using leverage and risk management helps keep your money safe. You can still make the most of market chances. By using stop-loss orders and other methods, traders can boost their chances of success. Traders use stop-loss orders to limit how much they might lose. This is an important part of leverage and risk management. It lets traders set a closing price for a bad trade. This stops losses from going too high and gives calm in choppy markets. Combining good stop-loss strategies with other risk methods can save your money in unstable trading times. Using trailing stops helps protect and grow your money. A trailing stop changes the stop-loss point as prices move in your favor. This guards profits while still aiming for more. Also, guaranteed stop-loss orders make sure you exit at a set price, even if the market is crazy. This offers extra safety for your trades. For those aiming for financial freedom, handling leverage properly is a must. This is especially true for deposits ranging from $300 to $1,000. With a chance for monthly returns of 5 to 25%, understanding leverage and risk management is crucial. Remember, you could face monthly losses of up to 30%. So, it's vital to watch your trades closely, especially in different market settings. It's smart to use a full range of risk management tactics when you leverage your trades. Forex traders have different ways to use leverage. They pick strategies based on how much risk they can handle. These methods fall into either a careful or a bold group. Some traders play it safe by not taking big risks. They might use low leverages like 5, 1 or 10, 1. This keeps danger down, but could limit gains. Those traders do this to keep their trading steady and avoid wild market swings.